Today I have a very special video for you, and we're going to talk about, for the first time ever, about the best stock trading price action strategies. I've been talking about price action strategies and the best signals for many years, and today we're going to take a look at stock charts, and I will explain the best price action signals there and how to trade them. The first one is a pure price action strategy, and we're going to use concepts such as the triple tap, break and retests, and other price action confluence factors. So we're going to take a look at a stock chart, and we are here at the 1 hour chart, but you can use this on any time frame. And I've been talking about the triple tap for many months. It does work very well in Forex, and you can also use it on stocks, commodities, cryptos, or any other market. And the triple tap shows trend exhaustion. You really want to look for the triple tap in the right context, because context really matters in trading and in understanding the best signals. So when we look here at this chart, we can see the market is in a strong downtrend, and then here at the bottom we see the so-called triple tap. As the name suggests, we have 3 taps: tap 1, tap 2, and tap 3. And what you can see is, if you compare it to what has happened previously in the trend, is that this doesn't show a very convincing downtrend. Although the market kind of makes lower lows, you can see that it is very weak, and the distance from one low to the next is very short. So you can put any momentum indicator here, for example the RSI, the MACD, the stochastic. Any indicator will show you here a divergence, because it shows you, and this pattern really shows you, a loss of momentum. Obviously this is not good enough yet to go long, but if you are short here, then you want to consider definitely getting out of your trade, or at least scaling out of the position. What we also can see here is that we are building kind of a pattern. We have here our level, we have here a support level, and then here we have a breakout gap. In stock trading, it's very important to pay attention to gaps and where they happen and in what context. And breakaway gaps are really powerful tools, especially if they happen in the right context. And a breakaway gap has to break something, as the name suggests. So here in this example, the breakaway gap is gapping over the last swing point, which can also be, as we will see later, support and resistance levels. And this is a very strong signal, because it shows that the market, there's a lot of buying going on, probably a lot of sellers getting out of the market, which is also contributing to the bullish pressure. And then you have this huge jump here. Also, you can see the breakaway gap is taking us beyond this flip zone. We have a previous support level that turned into resistance, and the breakaway gap here didn't only get us above the resistance, but also brought us all the way above the flip zone. So very meaningful signal. Then you can see a retest occurs. Retests are very common. Many traders are not comfortable trading those breakouts, but retests are something that more traders are interested in. So now it gets interesting to look at a breakout scenario. When we wait a little bit, you can see here was the initial retest, and after the retest the market didn't fully take off, but we are building such a accumulation zone. I made previous videos on my YouTube channel, you can check them out, about accumulation and distribution. It's a very important pattern, because an accumulation is at the starting point of a new trend, and it shows you that the previous downtrend is over. During the accumulation, there's a lot of buying going on. Everybody, or not everybody, but a lot of people who were short previously are getting out of their trades, taking profits, and a lot of bullish pressure is building here. And the final piece to the puzzle is then the breakout out of such a pattern. Here you can see we have a very nice trend line. We can connect the high, the high, the high. So we have a good trend line that really defines our accumulation phase very nicely, which helps us then to time a more objective breakout here. So we have a very strong breakout candle. And when you look at the size of the candle, that's also quite meaningful, because when we look at the size, this is probably one of the larger candles that we are seeing in all of this chart context. How many candles are here? Probably around 100, maybe a little bit more, maybe a little bit less, but this is possibly the strongest bullish candle, maybe with the exception here. But you can see, when we pay attention to candle size in the right context, that's also very important. And then you can see afterwards the market really took off. So as I said, during those accumulation phases down here, there's a lot of bullish pressure building up. And then once the market breaks out of it, it's often really exploding. So we have to wait for the breakout out of such a pattern. But if we see that it happens in the right context, with a breakaway gap after the triple tap, after the flip zone break, and then also in a strong downtrending context where Probably a lot of people are ready to take profits here. Then everything is coming together very nicely for you. Next is the so-called exhaustion reversal. Let's see how it looks in action. So what do you see here? That, well, you can also see a triple tap. We have a tap, tap, and a tap here. So 3 taps in a strong uptrending market. And here something really interesting happens. The market first shot up very, very strongly higher. The largest bullish candle that we are seeing here in this whole chart context. And I would assume if you zoom out, this is going to be a very historic candle, taking us higher. And then immediately the next candle afterwards is the strongest bearish candle and almost larger than the previous bullish candle. If we would align them, they're probably equal in size. So there's a lot of noise going on, and you will often see, and there's been this very famous quote that volatility is greatest at market turning points. And this seems to indicate also here at least a peak in volatility. So something significant is happening here. A lot of people are probably taking profits. Maybe there was a news event coming out and something very significant has happened here. Obviously, that's not good enough to go short. But if you are in a long position, at least you want to be very careful about what is coming next and be very observant. So let's see. So what we see here and what we always have to keep track of is how the market and how highs are behaving. For now, we can see the market is making higher highs and higher lows. So this is a classic uptrending structure. Now we also need to pay attention to not only where the highs, but also where the lows. So here is a resistance level that turns into support. We call it a flip zone, resistance turning into support. So we know where's a recent high or where's the highest high, and we know where's the low. I also added the 50 period SMA to the chart, which is a very helpful trend filter used by a lot of traders. Now we can see the market failed to break the highest high. And not only did the market fail to break the highest high, which is already a very bearish signal, here's also again a very strong breakaway gap that brought us below this flip zone. And then the following candle brought us here below the moving average, which the market wasn't able to trade lower or below for weeks and weeks. So also a very, very meaningful signal that is happening here. And afterwards, you can see the market completely fell over and rolled over. So the point here is that when you see volatility peaks and you are in a buying position prior, it is not a bad idea potentially to think about at least lightening your position, maybe taking partial profits, and then observing what is happening next. With number 3, we're going to take a look at various continuation patterns. So we have here the 1 hour chart, and we zoomed out a little bit, and I applied the 4 hour 50 SMA to your charts. So in TradingView, it's very simple. You just add the moving average, you type in 50 period, and then when you open the settings, you can select the 4 hour time frame very easily. And then you can basically see the higher time frame moving average on the lower time frame charts. And what is very common in FX, but also in stock markets, as you can see here, is that the market is drawn towards the 50 SMA, especially after an initial break. The market often comes back to retest it. So here's the break below, we retest and continue. Here we break the moving average from underneath, then we retest it and continue. Here we break below it, very dirty retest, and then here the next time is a more accurate retest. And here as well, we break above it, close the gap, and then trade away from it. Sometimes the market comes back to the moving average later points and also give you patterns. So you can see there are 2 green arrows, and we will now take a closer look at first what is happening here and then what has happened here. So when the market is coming back, and this is still the 1 hour time frame and the 4 hour moving average, you can see the market is slowing down. It is moving into the moving average here. It is slowing down and is slowly turning. You can see prior the market made lower lows and lower highs. And then here it is changing. It is making higher highs and higher lows. Here's an important resistance area. Here's an inner trend line. And then we have our famous beloved breakaway gap. So we're gapping above all of this here. There's a lot of pressure building on. Keep in mind, at this point, this is exactly here, we are above the 50 period moving average and the price is technically in an uptrend. So probably a lot of traders are waiting here to join the ongoing uptrend, and that is why there's a lot of pressure building here during this phase. Now we're going to take a look at this example here. What has happened here? The market is in a strong downtrend. Keep that in mind when we're looking at the zoomed in picture. So here you can see the market is trading into the moving average. And how does it trade into? With a flag. I made many videos about flags. They are very common, and not only are they common, they are high probability price patterns. So it pays attention to look for flags, especially if they happen in the right context. The right context being here in a downtrending market at a moving average pullback. And you can see the market hasn't been back to the moving average in a while. There hasn't been a significant pullback in a while. So the market always moves in those waves, up and down, or here, down and up, down and up. And if you are looking for a bearish continuation, you want to wait for such a relief consolidation. So you wait for the market to move a little bit higher, consolidate, and then time your trades in accordance with the higher time frame or just the bigger picture trend direction. So now let's take a look at a multi-time frame trend trading strategy. And as you can see, and if you have been watching my videos for a while, maybe some of the things will sound familiar. I have made dozens of videos about price action strategies, mostly about FX and crypto in the past. But as you can see, everything that I've talked about in previous videos is 100% applicable also to the stock market. And if you want to learn more about my trading courses, my video courses, make sure to check the link in the video description below. They are strategies for price action, multi-time frame, and can be used for any market. So what we see here is a supply zone gap scenario. So what happened here is that here was the origin of this huge jump in price. And the market again had a breakaway gap. And at this origin, we can identify a supply zone. Very important, supply zones are at the origin of uptrends, demand zones are at the origin of downtrends. So in this case, it is supply zone, there's a breakaway gap, and the market then fills this gap, comes back to the origin of it, and completely reaches to where the gap closes. Then the next candle, you can see we are gapping higher. The red candle closed here, very important. And then the green candle opened all the way up here. So as the market reached here, the gap close, there was a lot of profit taking ongoing by everybody who was short, getting out of their shorts, which is contributing to bullish pressure. And also probably a lot of people had been waiting to trade the gap close. So we have twice the impact on the bullish side. So that is then why the market is gapping higher so much. And we are now at the daily time frame, and now we will drop to the lower time frame, which is the 1 hour. This is how it looks. Here's our gap. And still we have the moving average on our charts. I think it's a very helpful moving average in general. And here we are then now starting to understand what is happening and can we find a trading plan. So first of all, it's always important to look for flip zones. We have a resistance or support that turns into resistance here, right at the intersection with the moving average. So here is a very important cluster. Also, I added a weekly pivot point. You can see here, during this downtrend, the market is trading below the pivot point. It comes above the pivot point and rejects it. Comes above it, rejects. And now for the first time, you can see we are trading above the pivot, and for now we are holding it. So what would be a potential trading plan? A potential trading plan would require for the market to get above the moving average, to get above the flip zone, and to establish itself above the pivot point. And this is what happens here. With this candle, again, a small gap. We are now above the pivot point and we're staying above the pivot. We are above the flip zone and above the moving average. So 3 very important features here. And keep in mind, we are still trading in line with the higher time frame. So the higher time frame sets the stage for the lower time frame. And for now, it looks quite good that the market may rally higher based on what we're seeing. This is where we left off. This is the breakout candle. The market really nicely traded higher, so we are able to catch a new trend very early on. The market keeps trading above the pivot for a while, and then the market is making a move into the moving average. You can see we have a little bit of a gap below the moving average and an immediate reversal. And as I said a minute ago, the market is always moving in those ways. During downtrends, down and up, down and up, down and up. And during uptrends, it's the reverse. Up and down, back and forth. So if you're looking for a bullish scenario and you have missed maybe the first part, or maybe you want to add to your position, or maybe you took exit and then when you want to get into the trade again, what you do is you wait for such a bearish sequence to end, and then you wait for the continuation. You want to see that the market is being able to get back above the pivot point and above the moving average. which just happened here, just a little bit after. The market is back above the pivot, back above the moving average, and also back above the previous highs. So very, very bullish signal overall. And you can see this is what was here. The market continued higher a little bit, and then it rolled over. First, you can see we are making lower highs. The market jumped below the moving average. It tried to break above the pivot point, above the moving average, but here now is a very, very strong cluster zone. And the cluster held. The market was not able to establish itself above the pivot or the moving average, and not even come close to the previous highs. So at this point, if you are in a long position, maybe from here, maybe from the continuation, you definitely want to think about protecting your trade, maybe even exiting fully, and maybe even getting ready for the downside. You can see here is a support level, and the market had its famous breakaway gap, gapping below it. Again, a lot of accumulation, in this case the distribution going on, and then we are gapping lower and continuing lower, and that is then how it looks. So really nice multi-time frame study. We started here looking for, after the gap closed, for the bullish side, continuation, and then as the market failed to break higher, tested the pivot from underneath, we are rolling over. So those are very universal principles that you can use for stocks, but also for any other market. And if you have any questions, let me know in the comments below.